If you have less than $10,000 in your bank account, you aren't just a customer to Wall Street. You are a profit margin. The global banking system is divided into 5 hidden tiers. Once you cross the $10 million threshold, the institution's primary objective shifts from extracting fees to helping you legally bypass federal taxes. Identifying these specific wealth levels is the only way to avoid the traps engineered to keep average earners stagnant. By the $25 million mark, the bank begins building custom financial instruments that insulate your capital from market volatility. We begin at Tier 1, the $0 to $10,000 range. At this level, the bank makes money off you rather than with you. Major banks generated $7.7 billion through overdraft and maintenance fees. This chart shows how penalty fees drive retail revenue. This is the poverty penalty. While savings yield 0.06%, well below inflation, banks lend your deposits via credit cards at 21% interest. For a young professional with a thin credit file, this often means being denied a small emergency loan or being forced to accept interest rates north of 20%. The Tier 1 experience is designed to monetize financial instability. To build actual wealth, you have to move your capital into Tier 2. Tier 2 begins at $10,000. Once you hit this threshold, the bank's internal algorithm upgrades you to premium status. This level provides waived ATM fees and access to a dedicated financial advisor. These perks create a sense of exclusivity, but they are often a gateway to high-fee products. The bank's objective here is to move your capital into high-fee mutual funds, which allows them to collect recurring revenue from your growing assets. A 1.5% expense ratio on a mutual fund seems negligible. However, as this graph shows, that fee strips away 30% of your total gains over a 30-year period by eroding the effects of compounding interest. Tier 2 provides comfort, but not growth. At this level, you are still a mass market target being sold a retail product under the guise of specialized wealth management. Tier 3 begins at $100,000. This is the exact point where the bank views you as a potential asset rather than a liability. The business model changes. The bank shifts its focus toward preferred mortgage rates and managed investment portfolios, prioritizing a long-term relationship over flat fees. While 6 figures is a significant milestone for a retail customer, private banking divisions still view this amount as entry-level. Hitting Tier 3 stops the extraction of small fees, but it does not yet provide the specialized lending facilities used by high-net-worth individuals. At $1 million, you enter Tier 4. This is the world of true private banking, where the institution treats you as a business partner. This level introduces securities-backed lines of credit, or Lombard loans. Consider the cost of buying a $500,000 home. A retail investor typically sells stock, triggering a 20% capital gains tax. A Tier 4 client keeps their stocks in the market and takes a 1% loan against the portfolio to buy the property. This strategy allows the client to access immediate cash while their stock portfolio continues to compound. Because debt is not classified as income, this transaction generates 0 tax liability. High net worth clients utilize bank-provided credit lines to generate liquidity, bypassing the tax penalties associated with selling appreciating assets. Between $5 million and $25 million, the relationship becomes bespoke. At this level, banks engineer proprietary financial products specifically for your estate. Through structured notes, banks can provide downside protection, guaranteeing that your principal remains safe even during a market crash, in exchange for a cap on your potential growth. You gain access to pre-market IPO allocations that generate immediate profits. The service becomes so specialized that bankers travel directly to your home to coordinate with your legal team. The financial system is not designed to reward labor or loyalty. It is calibrated to reward the accumulation of appreciating assets. To escape the bottom tiers, you must move beyond traditional saving. Real wealth comes from converting cash into compounding global assets, allowing you to utilize the banking system for leverage rather than paying for it through fees.